Now, our second presenter will be Martha Stokes. She is from TraderS. So I'm going to go ahead and bring Martha on now. Now, Martha Stokes is CMT, is the CEO of TraderS, the gold standard in stock market education. She is a former buy-side technical analyst, and since 1998, she has co-created over 40 TraderS stock and option trading courses for investors and traders. She has been a guest speaker for TradeStation, MetaStock. She has been a trader for TC 2000, Money Show, and AAII, Boeing, Option Traders, Livevol, and Winning on Wall Street. Hold on one second. I need to dismiss Dan here. And there we go. Okay, great. We'll be bringing on Martha here in just a moment. Now, she has written articles for Stocks and Commodities Magazine, TC 2000 Third-Party Research, TechnoTrader Weekly Publications, eZine.com, and numerous others. She specializes in relational analysis for stocks and options, as well as technical, fundamental, and risk analysis. Her focus for long-term investments is new displacement technologies that will have a significant impact on the stock market. Martha is a member of the Market Technicians Association in New York, and she earned her Chartered Market Technician designation, which is recognized and approved by the SEC, and her thesis, Cycle Evolution Theory. So what I'm going to do now is I'm going to go ahead and bring on Martha Stokes from TechnoTrader.
So let's get started. Who will benefit from this education? The education and training presented today will help stock, options, futures, and other types of technical traders, so anyone who uses technical analysis. HFTs have been in the news recently due to their front-running tactics, and yes, they front-run retail traders all day long, everywhere. There are debates about how they get news feeds in advance of other market participants and how they are hooked directly into the exchanges and whether this is good or bad, but the goal is to not constantly argue and be glum about these things, to find solutions so that you can front-run them, and this is what this is all about. Today you will learn how you can front-run the HFTs, getting in before the runs and gaps their orders create. Beginners, you may feel overwhelmed as this is an advanced training session, so take one thing and learn it. Please take notes as we're going to cover a lot of material and you'll need this information to use this information. Before you can start to exploit the high-frequency trading momentum price patterns, you must understand what they are doing, why they do it that way, when they trade, and how they trade. We're going to cover these aspects because without a full understanding of HFT trading, you can't take advantage of it. HFT trading is unlike any other market participant group. A few, like Getco, have market maker status. In other words, they are market makers. They make the market. They have an obligation to make the market. Most, however, act as maker-takers and are paid a rebate by the exchanges to provide liquidity. Maker-taker is a term that on the professional side that means that the individual is being paid a rebate by the exchange to provide liquidity. In other words, offering orders out to buy or sell against those orders that are coming through the market. HFTs trade on the millisecond. This means the HFT computer can fire off 1,000 to 3,000 orders per second, or 60 to 90,000 orders per minute, which is critically important to you because that is 60,000 times faster than a retail trader can trade. SEC regulations and even in Europe stipulate that retail traders are not allowed to trade on the millisecond. The typical retail order is required by law to be executed and filled within 90 seconds. Therefore, all retail day traders have significantly higher risk as they can't see the millisecond action or the direction the HFTs are moving the stock. 60 seconds is a long time to not be able to see what is going on with a trade. So there's not a level playing field anymore for retail day traders, especially early in the morning. Since high-frequency trading firms are not human beings, you must understand what triggers their computer-generated orders, when these orders trigger during the day, why they trigger, and how it affects price. There are 6 primary strategies that are incorporated into the HFT algorithms at this time. Some go after the retail investors and traders, specifically targeting the emotional reaction from these market participant groups. Most are tied directly into exchanges as low latency is their priority so their orders can jump over smaller orders. So what we have is we have dark pool activity, and as you'll learn today, and this is something you need to write down in your notes because you won't remember it, and you need to Have this as a mantra. Dark pools do not move price. The giant lots, 100,000, 500,000 shares, do not move price. It's their intention. That's why they use dark pools, is to not move price. High-frequency traders want to move price and often cause huge gaps such as this one. So one-day event, they'll have huge volume, huge accumulation distribution pattern, huge spike on candlesticks. That is an HFT footprint, and if you study stock charts and use the hybrid indicators, it'll be easy for you to identify the HFTs and eventually discover how you can get in here and ride the gap up. Dark pool or twilight pools are also known as alternative trading systems or alternative trading platforms. They account for 8 to 10% of the consolidated tape, which contains all the orders for the day. Yes, they show up on your stock charts, the delayed orders. A giant lot is anywhere from 100,000 to 500,000 share lots at a time. Dark pools are off the exchange OTC orders on alternative trading systems. HFTs chase dark pools to attempt to front-run giant lot orders, and there are dark pools everywhere in the world today because there are a lot of mutual funds and pension funds that want to be able to purchase stocks without being disturbed. They have to be in a dark area because if they list their 100,000 or 500,000 share lots as they used to during the 90s and the early 2000s, then everybody would be trying to front-run them and they would be paying more. They don't like this. That's why they have dark pools. ATSs were designed to thwart HFTs. All too often, retail traders are trading against these giant lots because you don't use indicators that show where they are. Price indicators do not reveal dark pool activity because dark pools do not move price, and that's the toughest thing for the average retail trader to understand, whether you trade options or futures or currencies or whatever. The dark pools are not going to move price. Their specific goal is to not move price but buy millions of shares of stock over time. Hybrid indicators, which disseminate between uptick and downtick, large lot versus small lot activity, do reveal dark pool activity. They're the modern leading indicators that you need to start using with your other indicators that you like. So we have dark pool activity that goes on, and we can see it in the primary hybrid indicators that are going on, and we can see that they're accumulating, and they keep price in a very tight specific price range. They've actually created the new type of sideways action called a platform. A platform is not a trading range. It is much tighter, but it's wider than a consolidation. And what it is it's the dark pools have specific orders that they say, buy me in if the price moves in this range, but don't buy me in if it goes above this range. And over a long period of time, several weeks to several months, they can accumulate millions of shares of stocks, 100,000 to 500,000 at a time, and not be disturbed. And like all the gurus that are out there on the retail side that tell you after they've bought their stock, oh, I bought IBM or I bought Microsoft, so you should buy it too, that triggers the HFTs to gap and run up. And here you have your high-frequency trader activity right here, which is the gap up. They're very specific. So these two giant market participant groups have completely different price patterns that you need to learn, and you need to be able to use these indicators that show the difference between large lot activity and small lot activity so that you can see before the stock moves up that you can get into this little accumulation pattern here and then ride the run up and then sell as the professionals sell. This is what all the professionals are doing. They're front running the HFTs and they're making a lot of money. So you can do this also. HFTs are just the opposite of dark pools in terms of price action and candlestick patterns. HFTs are trying to force price to move quickly and in large volatile or velocity intraday patterns. They love the first few minutes of the day. So if you're trying to be a day trader using outdated day trading techniques and strategies of trading the first few minutes of news in the day, you're headlong into HFTs. Gaps are far more prevalent nowadays and are often huge. Gaps and extraordinarily long candles are the primary candlestick patterns from HFTs. These are rarely a reversal pattern. Dark pools tend to create the reversal patterns. Most retail traders unwittingly chase HFT action due to news, trading strategies, volume actions. Small funds with VWAP orders also are caught in the HFT order flow. So you have a huge gap down and you have a huge spike in volume. So all of these are showing. And then all of a sudden price stops. You have a lot of smaller funds still trying to sell and dump in here, but you have a lot of activity from the dark pools moving in quietly. HFTs do not use technical analysis as you do. They do use MACD and stochastics, and I'll get into that in a moment. So they're not following things because they're computer algorithms. They also, once they hear that dark pools have been accumulating, will move price up with a huge volume and a huge spike on the large lot versus indicator, which is the difference between whether the uptick has the large lot or the downtick has the large lot. And this is very important in these markets because these two giant market participants are very dominant, a lot of activity going on, which you need to follow. Ts create gaps. You can have a trading range. This is a trading range, and then all of a sudden HFTs will gap way up over that. In order to manage, you have to learn how to enter prior to those gaps. The whipsaw trade. I'm sure that if I asked for a raise of hands, everyone would say that it's at least a few whipsaws in their experience, if they have any, if they have been traded in the market. Retail trading systems are not as sophisticated as professional trade forums. That is because the professional can spend a lot more money than you can on a Often retail trading systems attempt to mimic professional quant systems using popular indicators such as MACD. So you have a trading system that's built with a red light, green light, or a trigger signal using MACD. This creates cluster order flow. High-frequency trading firms use these indicator formulas to find anomalies in order flow. In other words, there's algorithms specifically written to follow the MACD anomalies in order flow that MACD creates using the trading systems that so many hundreds of thousands of retail traders all try to use all at the same time. When cluster orders are identified by the quantitative formula, it triggers electronic orders that cause whipsaw action and losses for retail traders. They literally can jump over your orders. MACD and stochastics are the most popular HFT indicators to find cluster orders to front run. So let's take a look at normal order flow patterns. The normal order flow pattern, a variety of different, all coming into the market at the same time. You have up here an at market order from a small investor who doesn't know any better and doesn't know that they shouldn't be using at market orders ever. You have some professional traders buying some stocks with their specific orders. They have a lot of variety of orders they can use. Pools who are using time TWAPs and other orders that it's a bracketed controlled order that they use. And you have your limit orders, which professional retail traders have not been using, but the retail side of the market still uses limit orders, and we have them down here where you're buying as the stock is moving down thinking you're saving money. Cluster orders look like this. In other words, hundreds of thousands of retail traders are all using the same very popular trading systems. Everybody uses MACD, and the high-frequency traders can find these and they can trade ahead. In other words, buying or selling in advance and then selling into your buying or selling. Dark pools use very controlled order flow. Their platforms are very precise highs and very precise lows. They're wider than a consolidation, but they're not as wide as a trading range. They're much narrower, and they're very controlled and very precise. And they use these for accumulating in bottoms and during moderately trending markets, and they also use them to distribute or rotate out of a stock at a top. This is what high-frequency trading looks like. You do have a decided advantage. Since institutional algorithms are computer-generated accumulation or distribution order flow, their patterns are predictable as they tend to repeat. Repetitive price action by dark pools allows you to prepare for sudden momentum moves. One thing you need to remember is that retail traders are the predominant users of technical analysis, along with professional traders. Dark pools are not using technical analysis. Mutual funds are not using technical analysis, and HFTs are not using it. HFTs rarely use technical analysis. This gives you the edge you need to be able to enter prior to HFT action, because they can't see things as you see them. Many HFTs chase giant fund dark pool buying and selling because they want to try to jump in ahead, but they end up chasing. If you can use this to your advantage if you learn to recognize the footprint that dark pools leave on the daily charts that you have. So dark pools will buy in bottoms and low areas, and they will quietly accumulate in a very tight price action. High-frequency traders will drive price up. Retail traders will buy high, and then the price will drop, and they'll lose money. Or they'll buy in here. Small investors may be buying in here. So this is a millisecond chart, and it shows you that the dark pools are very incremental about what they're buying on their volume, and then the volume spikes as high-frequency traders enter, and high-frequency traders chase high-frequency traders, and so on and so forth. As professional traders, we found a way around this because we have to. We can't sit around grumbling and griping about how awful HFTs are. We have to find a solution to trade so that we can take advantage of them, and we have. Market structure, trade order flow. Order flow is based first on price, the price offered, the time that the order is entered into the market, and the quantity, also the size of the lot order. The various types of orders coming from the diverse venues create the market conditions and the price and volume patterns seen on your stock charts. Dark pools use various types of TWAP orders. Their orders are specific to dark pools. They're catering to the large mutual funds and the pension funds, the sovereign funds, the foreign funds, all investing in stocks in the U.S. and Europe. HFTs use news, arbitrage, MACD, and other retail indicators and systems to trade against. So they're using news. They're using arbitrage situations between Europe and the U.S. They're using MACD. And smaller funds use VWAP. We have tens of thousands of smaller funds. They have become enamored with VWAP, and so they end up chasing HFTs because VWAP triggers on large volume. Retail traders use limit orders, which you should get away from. Smaller lot investors use at-market orders. You want to be using a bracketed order like the dark pools because that's the most protected order you can have. So let's talk about market structure. This is a high-frequency trading desk, and there is nobody there monitoring. The financial markets are evolving at an unprecedented pace. This is due to the early adopters of the financial markets using new technologies and advances in analytics. The market absolutely loves new technology. It absolutely loves it. Retail traders are mostly using outdated technical analysis, outdated strategies, and obsolete trading systems from 20 years ago. With over 80% of all the orders now fully automated, it is imperative that the retail trader understand the magnitude of the market structure changes. So let's start real quick with here. I don't have much time to go over this. Dow theory, and most of you should know this, but I discovered that most of you don't, said that there are three levels of market participants: the informed buyers, the average investors, and the odd lot or uninformed investors. And he said that the informed buyers constituted 50% of the market, the average investors, the middle class, 40%, and the uninformed odd lot, 10%. And that was written in the 1890s. This is the market structure we have today. The circle of market participants has 9 distinct different groups. We have sell-side institutions, buy-side institutions. We have 10 million billionaires in the world. They impact the market. Corporations impact the market dramatically. They can do all kinds of things to, they are the supply side of the market. They can do buybacks. They can do splits. They can offer secondary offerings. They control a lot of activity. Institutional traders, the human trader is coming back. We're discovering, fortunately, that human traders are very valuable, that a computer will not do it for you. High-frequency trading forms are all over the place. Smaller funds, foreign funds, sovereign funds. Retail traders, you're way up here. You get in late. You don't take advantage of all the run you could have. Small lot investors get in very high on a dip, and then the odd lot investor at the very top. So we're looking at high-frequency traders. So market condition analysis is what I developed for my trading floor when I was taking care of day traders and swing traders. The market participant group's activity of those 9 different market participant groups creates the 6 different market conditions in today's market. The bottoming market, the platforming market, the moderately trending, the velocity, the trading range, and the topping market. These are the 6 market conditions we currently have. 4 of these conditions are sideways patterns: bottoming, platform, trading range, and topping. Each sideways pattern is unique to that market condition. Each one is different, so you have to recognize those different sideways patterns. The automated marketplace trends sideways 70% of the time. Moderately trending and velocity are trending markets for both the upside and the downside. Downside price action is very different than the upside due to the lower number of market participant groups actively trading the downside market or selling short. So we have far fewer market participants on the selling short side than we do on the buy long side, so that totally changes how downside price action behaves. Plus, instead of having the uptick rule for selling short, we have curbs and pauses, which totally alters how the downside can move. So you need to be able to recognize those if you want to trade both sides. Market condition will tell you who is in control of price, which of the 9 groups or which of a couple of those 9 groups together are controlling price. Right now today, I can tell you HFTs control price. What technical patterns are most prevalent, because that will tell you how to trade, what you can trade, when you can trade. How will price behave at resistance and support? Different market conditions, different sideways action provides different types of resistance and support. It's not always the same: weak, moderate, strong. What trading styles work best? What entry and exit signals will work best? Just because you see an engulfing white doesn't mean that it's going to work. It has to be on the market condition analysis. What indicators to use? You cannot use the same indicators on every market condition. If you use a stochastic indicator during a moderately trending or velocity market, it's going to tell you to exit too soon. Market condition analysis is derived from the market participant cycle, and it tells you which market participants are active at this time, which market participants are sitting in the sidelines and waiting for opportunities. How will price behave when that group controls price? How volume and quantity indicators react and the patterns that form when the group controls price. So quantitative market condition analysis, I want to know, what I did is I had to find a way better than futures and better than the indexes. The index is always leg, and the futures don't tell me anything more than how the market's going to open. So I created 7 scans that give me every stock to the upside that's moving with momentum for that particular day. At the end of the day, I open up my scans and say, how many are moving to the upside? How many are moving to the downside with momentum? That gives me the bias of the market. It doesn't matter what the indexes are doing. I need to know what the general large body of groups of stocks are doing. The indexes only cover a few hundred stocks. I need to know what thousands of stocks are doing on the market to tell my people what direction the market is going to move. Institutional activity. I want to know, are the dark pools active? Are the HFTs active? Is it mostly smaller funds? I need to know which groups are actively trading. Dark pools will sit out and pause for a period of time, then suddenly they'll come back in. They love quiet, insipid index days. If the indexes aren't doing much, the dark pools are very active. Bottoming stock market condition, the dark pools create the bottoms, and so you want to be knowing when stocks are starting to bottom after a correction. Consolidation stocks, how many stocks are consolidating, because that's faster energy, moderately trending velocity. That means that human traders are taking over. We're getting a lot more dynamics, and we want to see activity there. The overbought stocks tells me whether we have a range-bound market condition. Again, indexes may show that, may not show that, but range-bound trading range market conditions are they're an animal into themselves, and they have to be traded specifically, or you'll get whipsawed constantly. The platforming market condition is the easiest of all to trade because it's very consistent. The dark pools are moving in incrementally over periods of time, and they create these lovely platforms that are very low-risk entries. By quickly comparing the number of charts each pulls up on any given day, you can easily determine what market condition is present at that time, and this is what I do for my students. From there, it is simply a matter of using custom scans in order to find stocks which will outperform your normal retail trading systems. This incorporates quantitative analysis into your trading process in a simple, fast, and highly reliable method. And as I said, this is a professional method. So this is how it looks. These are the scans that are pulled up on this particular day that I snagged this momentum buy 70, momentum sell 19. Okay, buy side has the momentum. Institutional activity 251. That's a very high number. It means the dark pools are very, very active. There also were buying. This was in June, and the heavy accumulation buying into bottoms. Consolidation was also very high, so there were a lot of stocks consolidating out of bottoms. So we were going to have swing trading opportunities, position trading opportunities, day trading opportunities. Range bound, trading ranges were gone, very low. And platforms, we definitely had a platform market condition. That was the highest scan. And we had a lot of platforms forming because we had a lot of institutions quietly accumulating, moving in ahead. You can trade with the retail traders, but they're unreliable, they're inconsistent, and a lot of times they got front run by the HFTs. If you learn to buy with the institutions, the dark pools, you'll have far greater success and more consistent success. So market condition analysis identifies the bias and energy for the day-to-day trading activity, the direction and the sustainability of the trend for the intermediate term and long-term trends. MCA defines how you should trade, what trading styles will work optimally, and which strategies can be used successfully. Not every strategy will work in every market condition, and I'm sure some of you have discovered this, that you have a strategy that works and then suddenly it stops working. It tells you what indicators you should be using. If the market is moderately trending, you would not use overbought, oversold indicators, as these indicators would signal an exit as a stock started a momentum run. And this is one of the most common problems I see. Or you use a momentum indicator like MACD during a platform building market, and then you have whipsaw after whipsaw. You have to use the appropriate indicators. MCA defines what candlestick patterns will work optimally, how support and resistance will behave, and what exit strategies will be best. It also helps you determine the proper risk to profit ratios to use. There are certain conditions where you can use higher risk to profit ratios than others. With this information, you are ready to create your own trading process unique to the trading styles you prefer to use. So instead of following the crowd, be like the professionals. The professionals all have very specific proprietary trading processes that they have developed, and that's what I teach my students is don't follow the crowd, don't trade with like everybody else, because you're going to get whipsawed out because somebody's going to see those cluster orders and they're going to wipe you out. So I don't have a lot of time today to present all that I need to tell you about market condition analysis, so what I'm going to do is something I don't do very often. I'm going to let you join me on my mentoring notes blog for 2 weeks with the daily market condition analysis and market open reports. This is exclusive to students usually, and this is where I give my students guidance on the market and trading conditions for the current trading day every day a couple hours before the market opens. I'm up Pacific daylight time about 3 o'clock, checking the markets, looking at the pre-market activity, because a lot of times I can see the dark pool activity, HFT activity, and I can start guiding my students as to what direction they need to go. I also often provide examples of prevalent chart patterns that are occurring, which are helpful as you approach your trading day so you can understand what's going on. So each day is unique, and this is strictly additional training. It's not a sales pitch. I'll have more about this at the end of the conference, but I did want to explain that, yes, I am aware I'm not explaining enough about market condition analysis. I don't have time in 40 minutes. So high-frequency trading is easy to see in your charts. Determining what they are using in their formulas is also in the chart patterns. Here are the current common formula-based trigger signals. Please write them down. Dark pool activity, which crosses into exchange transactions or is momentarily lit on twilight pools. In addition, dark pools allow their accumulation to leak out, just like gurus on the retail side, to the rest of the world. So dark pools accumulate, and then they'll let all the smaller funds and everyone know, oh, we think that IBM or Microsoft or Cisco or whatever is a great stock. We have invested in it. And so then everybody buys it, and of course then the price moves up. Retail gurus do that all the time. Retail news, guru recommendations, retail events, which the formulas have predetermined will create a specific reaction from the retail crowd. They've studied you on Twitter. They've studied you on stock twits. They know how you react to certain kinds of news. So they write an algorithm that will front run you right into those things. So be very careful with any of these, because they know how you're going to react and they get ahead. Earnings report pre-news release. Data, right now HFTs are extremely active because we have earnings reports, and the pros, it's been kind of fun because the pros have figured out how to jump in ahead of the HFTs, especially if the earnings news is announced later on. They can get in either end of day or pre-market early on before the HFTs run the price up. Company news, which will create a predetermined retail crowd reaction. Again, we're looking at retail crowd reaction to company news, and HFTs front run that. Overseas market activity prior to U.S. market open, if they can get an arbitrage in there, it's gone in a millisecond. Retail broker activity, indicating which stocks retail are most interested in buying at that time. So they're following retail brokers to see what you want to buy, and they're front running that. Incorporating MACD or stochastics in the algorithm to find cluster orders, one of their favorites that they use all the time. So we have a classroom exercise so you can kind of see how that goes. All of these indicators are based on accumulation distribution. There are large lot, small lot activities comparing the relationship between large lot purchasing and or buying and selling and small lot. And that's what we're trying to look at. We have some HFT activity going on right here. These huge spikes in volume. One thing you should do that a lot of people, two things you should do with your volume bars. One, color them. Red for down days, green for up days. Two, use a moving average so you have some sort of structure into your volume so that you compare what's average for the stock and what's not average, because high frequency traders will show up as these huge spikes. Nice indecision day there. What happens when that indecision day there is that we have dark pools selling into the high frequency trading buying. So we have a stock that made a nice short-term bottom, quite accumulation occurring in here. It hit resistance from here. It moved it, struck the resistance again, came back up again, and now it's a third time up. Third time's the charm. A lot of times on these bottoming formations, especially if you've had quiet accumulation moving on and not a lot of high frequency trading activity, we have a positive divergence here, positive divergence here. We have good volume, and we have the large lot accumulation indicators showing that, yes, they're accumulating in this little tight range. So their price range is just about 4 points right here. They don't move price much, but they do move it within their buy zone. It's called a buy zone, and that's their buy zone, and that's where they're buying. So we can enter this stock about this time and know that very shortly we can expect to see high frequency traders, because they'll hear about this as it completes the bottom. And so we have quite accumulation, and we have a high frequency trader occur the next day. They move price up, breaking through the resistance level on high volume, and all of your indicators spike up because you have smaller lots, you have retail. Everybody's chasing that huge volume on that early market day with high frequency traders. So we have quite accumulation, and the high frequency traders follow it. So that's your high frequency trader pattern on all the indicators. These are all volume indicators. There are no price indicators. Don't need price because dark pools don't move price. So we have, that's the day where high frequency traders were. Then we had some heavy buying by some smaller funds activity. You can see it dipping down a little bit. Now we have another little consolidation period here. We can expect to see another big move on the high frequency traders again because of the way things are setting up, and they gap at this time. High frequency traders gap oftentimes, so what happens is professionals now go in end of day and they'll buy just before the close of the day, expecting that the high frequency traders will gap this up, and then they just sell as the high frequency traders are running the price up. It's a very favorite pattern to be trading end of day rather than the first part of the day for the pros. So here's a classroom exercise number 2, and we have another bottoming pattern, a little more action here. We have some quiet accumulation going on. We also have some high frequency traders trying to find their activity as well. We again have it hitting resistance, backing back down, hitting resistance again, and here's the third one coming up. It seems to be 3 times. It's usually the one that triggers the opportunity for high frequency traders to get into that. Again, all of our indicators are very positive and we're ready to go. And high frequency traders come in the next day and push it up with a lovely long white candle that if you had gotten in on this day, you could have enjoyed that ride up. You could actually be selling intraday before the next day's close. or you could continue to hold and it rides up. Now we have a consolidation. The tighter the price candles, write it down, the tighter the price candles, the more someone is controlling price. Those who control price are dark pools. They are able to control price very dynamically, and you can see how tightly they're controlling price. These are not indecision days. These are where they're trying to sell this stock down and take profits, but the institutions are buying this stock and holding it with their controlled bracketed orders very tightly. Whenever I see a pattern like that, it's pretty exciting because this is usually what follows the next day. HFTs discover this quiet accumulation and they gap the stock up again. So you can see that, one, dark pools are come out of bottoms, they come out of platforms. This is where you can find them. So if you can learn to identify platform patterns, they're very, very consistent highs and lows. They are a buy zone range for the dark pools, and the HFTs will chase them. So it's very easy using technical analysis and using large lot versus small lot indicators and properly set up in volume and your volume oscillators and your flow of funds indicators, that you will be able to find HFTs and trade ahead of them, because you can get in with the dark pools and get in when they're buying, and then just simply sit back and wait for the HFTs to take the price up. And that's a strategy that the pros are using, and it's very successful for them. The stock also ran up. Now you can see this is small funds buying with VWAPs and some retail traders and moving it up a little bit, but these are all smaller runs. You want to get in with the big run, and you could continue to ride this up, keeping your stop loss moving up as a trailing profit stop, so you could take a few more points off the table if you wished, and then allow the stop to take you out. So this is how the professionals trade. What happens is you retail traders are trying to buy in here, and you may get a few points, but you've really lost out on the big, big gains of this stock. Or you try to get in here, and then of course suddenly the next day it reverses down as the HFTs start selling it down, or pro traders overwhelm the smaller lots and take it down. You have to remember that the large lots, you have to pay attention to the large lots because they control price, and if they overwhelm the smaller lots, and you're all smaller lots, then the price will suddenly collapse. If the profit taking overwhelms, it will take over and it will just collapse everything, and you will have a tough time getting out profitably. So remember to always track large lot versus small lot activity. This is a large lot versus small lot indicator. On the upside, they're accumulating. On the downside, they're distributing, and you can see that this quiet accumulation in here, there was some pretty consistent patterns going on with this accumulation. They tend to make gray to green bars, and super spiky off the chart ones are smaller funds because there are only about 25 to 30 really giant mutual funds in the U.S., about 20 or 25 in Europe. Smaller funds, there's tens of thousands of them. Sovereign funds, there's only about 20 that are large enough to impact anything right now. Foreign funds, again, they're usually smaller. There's tens of thousands of those. There's also larger funds, and there's a few hundred of those. So it makes a difference on the patterns that you see on the large lot versus small lot. So high-frequency trading occurs in all types of stocks, from low-price small caps to big blue chips. They don't care. Their activity is easy to identify with volume bars and hybrid indicators. We teach how to use these leading hybrid indicators. When you know how to use these indicators, you can accurately and decisively track dark pool activity. This allows you to enter a stock prior to the HFT long candles or huge gaps. HFTs and bottoming formations chase dark pools, which is often a continuation pattern and has momentum behind the price action. Retail traders must learn to identify dark pool activity and enter before the HFT trigger orders. HFTs use retail news to trade against. Retail traders who use news to buy or sell a stock don't do it. HFTs use MACD and stochastics to find cluster orders that occur. When retail traders use these indicators, HFTs can easily front-run retail traders due to the time variance on order processing systems. So this is what we have for you today. Those are only for you, those of you who are watching right now. You can get my notes, which I give to my students. It's 2 weeks free by signing up at this address. This is where I provide my analysis of the market and trading conditions every trading day for my students before the market opens. And this information is invaluable. You will learn a lot. People who've joined, and I only let a few people on, really find it useful. And I want to help you out, so this is what we're going. This offer will only be available for today's attendees, and that's it. We're opening registration for only a short time after this presentation. It will close tomorrow, so you need to register today to get access to these reports. So that's all I have to present. I hope you learned a lot, and I hope you took some notes, because these are important points that you need to pay attention to. I think I have a minute or two to answer any questions.
Hi, Martha.
Hi, Emily.
Hi. I have answered these questions basically ahead of time, but I'm sure everybody would benefit from your answer as well. Frank asks, when and where does dark pool activity show up in reports? Are they included in the totals of the stock market totals?
Yes, every day, all orders, regardless, we have some 50 venues for dark pools. We have a couple dozen ACNs. We have about 13 currently exchanges in the United States, and Europe is very similar in those numbers. And what we have is all that has to be consolidated. Every order, no matter what venue it's executed on, has to go through the national clearinghouses. The national clearinghouses record, document, transfer of title, make sure that the buyer and seller exchange the money, have the money to exchange, all that. Whether you hold it for a millisecond or whether you hold it for 10 years, this transaction is completed as a transaction in the clearinghouse. Once the clearinghouses have all that data, they pool it into one resource called the consolidated ticker tape. That consolidated ticker tape is then, data is then sold to your data providers, your data feed providers like Thomson Reuters and Morningstar and other data feed providers. That is sold to the retail trader charting software companies and brokers. And that's why you pay fees, because it costs money. And from there it goes down into your charting programs. So the dark pools, delayed orders can only be delayed until the end of the day. In the last 5 minutes of the day, a lot of times all the dark pools orders will start being processed through, and you'll start seeing these huge volumes from the dark pool sides of the activities on your intraday charts. So I find that I don't trust the end of day, so I wait 20 minutes, because sometimes those orders are delayed and the consolidated ticker tape doesn't actually come down until about 30 minutes after. So if you want to wait about 20 or 30 minutes after the market closes in the US, I'm not sure if that's the same in Europe, but I suspect it is, then you would also check that at that time, and then you have all of the data from every venue on your charts.
Okay, we have time for just one more question, and it is from Tony. He asks, do you trade or manage funds, and how are their track records?
I used to trade and manage funds. In fact, I had a floor of trading. I was invited to be the technical analyst for several day trading firms. I retired a while ago, and I was very happy in retirement, and then my partner said, oh, why don't we teach a class? And that's how we got started with this. I found that the retail traders are not being given adequate information. What's out there on the internet is out of date, and it's so sad. You deserve to do better, and you need to do better, because retail traders mess up everything for professional traders. We still trade professionally for ourselves in a proprietary desk, but I don't offer to manage other people. I do have people who do manage other people's money that I can recommend to you. But I want to help retail traders, because you account for 10 to 20% of the market activity. You make a big mess of things because you're always doing things that cause you to lose money. Anytime any market participant group is losing that much money, it hurts the market. And so if I can improve what you're doing and help you make more money, that helps the stock market. That makes everybody more profitable, and that makes a better stock market for everyone involved. So I'm trying, my goal is to help in my retirement to help more and more retail traders succeed, because if you succeed, the stock market's going to be far more successful and everyone's going to prosper more, and that's the goal.
I just want to say thank you to Martha Stokes for that wonderful presentation. Martha Stokes, once again, from TraderS.